You ever think about how a huge company actually buys stuff? I mean, everything, from the raw materials for their products to, the laptop I'm using right now. Well, behind every single purchase, there's this hidden, pretty complex journey. Today, we're going to pull back that curtain and demystify the whole process. Just imagine the chaos for a second. You've got thousands of employees, all buying whatever they want. Vendors are sending in bills for stuff that never even showed up, and the finance team, they're just drowning in a sea of unchecked invoices. It would be a total disaster, right? So how on earth do they stop this from happening?
Well, the answer is a really powerful, structured system. It's kind of the hero of our story today. It's the one thing that brings order, control, and honestly, sanity to the whole world of corporate purchasing. And it's called Procure-to-Pay, or as you'll hear a lot, P2P.
At its heart, P2P is pretty much exactly what it sounds like. It is the entire end-to-end flow from the second a need is identified, that's the procure part, all the way through to that final payment being sent to the vendor. That's the pay part. You can think of it as the central nervous system, or maybe the official rule book, that everybody in the company has to follow when they spend money.
So to really get this, let's actually follow the journey of one single purchase from start to finish. We'll use a super common example. Let's say a department needs 10 brand new, high-powered laptops for their team.
Okay, so the journey always kicks off with a need. The IT department realizes the graphic design team's laptops are just not cutting it anymore. Now, they can't just go to a store and buy them. No way. Instead, they create an internal request, and this document is called a purchase requisition, or PR for short. This is basically them just raising their hand and saying, hey, we need these things, and here's exactly why.
All right, next, that PR goes up the chain of command. A manager takes a look. Is this purchase really necessary? More importantly, is it in the budget? Once they get the thumbs up, the procurement team jumps in. And they're not just looking for the cheapest deal. Nope, they're making a strategic choice, trying to balance price, quality, and how fast they can get it. With a vendor picked out, it's time to make things official. A purchase order, or PO, is created. Now listen, this is not just a simple request anymore. This is a legally binding contract. It tells the vendor, we are officially buying 10 of this exact laptop model for $1,000 each, and we expect them delivered by this specific date. It's a done deal.
A few days later, a truck pulls up, the laptops are here, but we don't just sign a clipboard and walk away. The receiving team gets to work, carefully inspecting the shipment. Are there 10 laptops? Check. Are they the right model? Check. Is anything broken? Nope. If everything looks good, they create what's called a goods receipt note, or GRN, which is the official proof of delivery. So we've placed the order, and we've received the goods. But, and this is a big but, before a single dollar changes hands, we have to meet the guardians of the process. These are the critical checkpoints that protect the company from mistakes and even fraud. Let's talk about the most important one.
And the head guardian, the big boss, is the three-way match. See, shortly after delivery, the vendor sends their bill. That's the invoice. The accounts payable team then does this absolutely crucial check. They take the three key documents, what we ordered, which is the PO, what we actually received, the GRN, and what we were billed for, the invoice, and they compare them line by line.
And this is exactly what they're looking for. Did we order 10 laptops? Yep. Did we receive 10 laptops? Yep. Did the vendor bill us for 10 laptops at the price we agreed on? Yes, they did. Boom. Everything lines up perfectly. This one step is what prevents companies from paying for stuff they never got or paying the wrong amount. It's a huge deal.
And the three-way match isn't working alone. It's got backup. It's supported by other guardians, like making sure only the right managers can approve spending, or validating that vendors are real, legitimate businesses, and running automatic checks to make sure we don't accidentally pay the same bill twice.
Okay, with all those checks and balances done, it's time to write this whole journey down in the company's financial storybook, the accounting system. This is what makes sure every single step is tracked with total accuracy. So the second those laptops are received and that GRN is created, the accounting story officially begins. The company now has a new asset, 10 laptops worth $10,000. But to keep the books balanced, they also have to create a note about a temporary IOU. It's like a placeholder for the money they know they're about to owe. In accounting speak, this means the company's inventory goes up. And to balance that out, they put that same value into this special holding account you see called GR/IR. You can literally think of it as a financial waiting room. The value of the laptops just sits right there, waiting for the official bill to show up.
A little while later, the invoice arrives and it passes that three-way match with flying colors.
So now it's time to make that debt official. The accountant posts the invoice, and that triggers the next big step in our financial story.
And this is where the money moves out of that financial waiting room we just talked about. The value gets transferred from that GR/IR holding account, and it's now officially marked as money that is owed to the vendor. That temporary IOU just became a real, actual bill that needs to be paid.
The invoice says payment due in 30 days. So on that 30th day, the final chapter of this whole purchase journey is written. The Treasury Department gets the green light and processes the payment.
And here is the final entry. The payment is sent out. This clears the debt to the vendor down to zero. And at the exact same time, the company's cash in the bank goes down. The IOU is paid, the laptops are ours, and the financial story for this one single purchase is now complete. Everything is perfectly accounted for.
So after all those steps and all those approvals and all those accounting entries, what was the point of all that? I mean, why does this entire journey matter so much to a successful business? Well, the value is just immense. This isn't just about dotting I's and crossing T's. A smooth P2P process is a real competitive advantage. It improves cash flow, it builds better relationships with suppliers because you're paying them on time, and it gives leaders priceless data to make smarter spending decisions in the future. It literally turns purchasing from just a cost into a strategic asset. You know, this process has been the bedrock of business for decades, but technology is changing the whole game. AI can now do a three-way match in a fraction of a second. So the question we're left with is this. As automation starts taking over all these repetitive tasks, what new roles and new strategies are going to define the future of how companies buy things? What becomes the next crucial step in the journey?